Welcome to VD Decode channel.
90% of amateur traders lose their money. Their portfolios collapse because they look at a stock chart and see nothing but math. A stock chart is a live, emotional battlefield where two extremely powerful human forces, greed from the buyers and fear from the sellers, are constantly fighting for dominance. The footprints left behind in this battle are called candlesticks. Each one gives you 4 pieces of data for a specific time period: the opening price where the battle began, the absolute high and low points the price reached, and the final closing price where the fighting ended. The color of that footprint tells you exactly who won the session. If the body of the candlestick is green, buyers pushed the price up and greed won. If the body is red, fear takes control and the sellers dragged the price down. New traders print out cheat sheets and try to memorize hundreds of different candlestick shapes in isolation, completely ignoring the underlying emotion that actually created those shapes. Knowing the name of a shape is useless unless you can decode the human behavior left behind in that footprint. Take the Doji candle. Its tiny body and long lines show brutal indecision. It tells you that buyers and sellers fought a fierce tug of war, but neither side gained a single inch of ground. You never trade a doji on its own. It is a warning sign that the current trend is exhausted, and you need to wait for the next candle to confirm who is actually taking charge. The hammer indicates a failed push lower. Sellers successfully crashed the price during the session, but buyers found the strength to reject that low and close the price near its peak. This is a diagram showing the hammer pattern. You can see its defining features: a long lower shadow, which is at least twice the length of the body, and a small green body sitting right at the top of the trading range. This chart displays the mean returns following a hammer candlestick pattern on the Nifty 50 index. It clearly shows positive returns across the 3-day, 5-day, and 10-day holding periods after the pattern appears. This setup introduces a major risk called a fakeout. A fakeout is a false signal where the price temporarily breaks out of its normal range, tricking amateur traders into buying before aggressively reversing direction. Large traders often enter the market at these visible levels. When they buy or sell in massive volume, they can trigger the automatic stop-loss orders of smaller traders, creating a surge of liquidity that forces a trend reversal. That long line at the bottom of the hammer represents the point where retail traders guessed wrong and were forced out of their positions. To map these psychological shifts, we look at multi-day formations. The Morningstar pattern is a 3-step signal, indicating that a major downtrend is ending and a reversal is beginning. Day 1 is pure fear. A heavy red block drops sharply. Day 2 brings exhaustion, leaving a tiny compressed shape. The market is balanced. Day 3 is the triumph of greed. A large green block erupts upward, crossing the midpoint of Day 1. The inverse of this is the evening star, which occurs at the peak of an uptrend. It is a signal that buyer momentum has died and a sharp drop is likely to follow. These multi-candle patterns serve as a map of shifting crowd psychology, illustrating the specific moment a trend loses momentum. If these patterns map human emotions so accurately, why do perfect hammers and morning stars sometimes still fail completely? A candlestick pattern floating randomly in the middle of a chart is often a false signal. Context is everything. Professionals follow a specific framework to filter these signals. You must evaluate the overall market structure, identify areas of value, set clear entry triggers, and know exactly where your exits are. The area of value is critical. A hammer is significant if it occurs at an established support level, a floor where buyers historically enter. You must also check the volume. A psychological reversal requires a massive vertical spike in trading activity. If there is no real money behind the move, the price action is likely an illusion. These principles govern everything from individual stocks to massive global indices like the Nifty 50. The footprints remain the same because human emotion remains the same. A successful trader looks past the visual shape on the screen and focuses on the emotional context driving the price. If you want to master stock market psychology, artificial intelligence, and the future of tech, all explained simply in Hindi, subscribe to VD Decode right now.